Welcome to Finance with EJ, where your financial dreams come to life. Get ready to supercharge your savings, crush debt, and make money moves that will leave you feeling unstoppable. Subscribe now and join the journey to financial freedom and generational growth building.
Ever wondered how successful investors make their decisions? It's not all about gut feelings or luck. Smart investing requires careful thought, research, and analysis. One crucial tool in the investor's toolkit is fundamental analysis. It's a method that involves evaluating a company's financials, its industry position, and the market conditions. This comprehensive approach helps investors make informed decisions, reducing risks and maximizing returns. So, how does it all work? Stay tuned as we unravel the mystery of fundamental analysis. Picture a map that leads to a treasure trove of investment insights. That, my friends, is a financial statement. Now let's talk about the basics of financial statements. At the core, we have three main types: the balance sheet, the income statement, and the cash flow statement. Each serves as a unique lens through which we can examine a company's financial health. First up, the balance sheet. This is essentially a snapshot of a company's financial condition at a specific moment in time. It shows us what a company owns, owes, and the equity it holds. It's like a financial X-ray, revealing the bones of the business. Then we have the income statement. This shows us a company's revenues, costs, and profits over a certain period. It's like a movie reel, capturing the dynamic flow of money in and out of a company. Lastly, we have the cash flow statement. This shows us how much cash a company generates and spends over a specific period. It's the heartbeat of a company, showing us the rhythm of incoming and outgoing cash. Why are these important? Well, they provide us with a comprehensive view of a company's financial strength, profitability, and growth potential. They enable us to make informed decisions about whether to invest, hold, or sell. So, in the complex world of investing, these financial statements serve as our guide, our tool, our map. They help us navigate the often turbulent waters of the financial markets. Truly, financial statements are the compass guiding us through the investment jungle. Now, equipped with our financial statements, how do we decipher the code? The answer lies in ratio analysis. Ratio analysis is like the secret decoder ring to the cryptic world of financial statements. It takes those numbers and turns them into meaningful comparisons that provide insights into a company's financial health. Let's consider a few key ratios, starting with the price-to-earnings ratio, or PE ratio. This tells us how much investors are willing to pay for each dollar of a company's earnings. A high PE ratio could mean that the market has high expectations for the company's future growth. Next, we have the debt-to-equity ratio. It measures how much a company is financing its operations through debt versus shareholder equity. A high ratio might indicate risky business, while a low one could suggest financial stability. Finally, there's the return on equity, or ROE. This ratio shows how effectively a company is using its shareholders' equity to generate profits. Ratio analysis, the Rosetta Stone of the investment world. But successful investing doesn't stop at company analysis. It requires a bird's-eye view, a grasp of the economic landscape. Imagine navigating a ship without a compass or a map. You might get somewhere, but chances are you'd be lost at sea. Economic analysis is that compass, that map for investors. It guides us through the complex, often unpredictable world of finance. The first waypoint on this economic map is gross domestic product, or GDP growth. It's the measure of a country's total economic output. If the GDP is growing, it might signal a booming economy and potentially profitable investments. But if it's shrinking, well, that might be a storm on the horizon. Next, we have inflation, the rate at which the general level of prices for goods and services is rising. It's like the tide. It can lift all boats, but too much of it can also capsize them. A moderate level of inflation is generally seen as a sign of a healthy economy. However, high inflation can erode investment returns, so keep an eye on that tide. Finally, there's interest rates. These are like the winds that can either push your investment ship forward or hold it back. Low interest rates can stimulate economic growth, making it cheaper to borrow and invest. Conversely, high interest rates can slow down the economy, making investments more costly. With economic analysis, we zoom out to see the investment world in its entirety. Yet, numbers tell only half the story. The other half lies in the human element, the qualitative factors. You see, the financial statements, ratios, and economic indicators we've explored so far are all quantitative in nature. They help us gauge the financial health of a company, but they don't give us the full picture. The other half of the story comes from the qualitative factors. These are the elements that can't be quantified or measured in dollars and cents, but are no less critical to the success of a company. Let's start with company leadership. A company's top brass sets the tone for the entire organization. Their vision, strategy, and ability to execute can directly impact the company's performance. Next, there's brand reputation. A strong brand can command higher prices, generate customer loyalty, and provide a buffer against competition. It's an intangible asset that can significantly enhance a company's value. Speaking of competition, the industry landscape plays a significant role as well. A company operating in a highly competitive market may face challenges that can affect its performance and growth prospects. All these factors, leadership, brand reputation, industry competition, they're all part of the human element. They're the qualitative factors that can tip the scales when it comes to deciding whether a company is a good investment or not. Investing, after all, is as much about understanding people and their behaviors as it is about crunching numbers. So, we've charted the financial landscape, deciphered ratios, zoomed out for economic context, and considered the human element. What do we have? A toolkit for making informed investment decisions, financial statements providing a company's health snapshot, ratio analysis breaking down the numbers, economic analysis painting the broader picture, and qualitative factors adding the human touch. We've woven these threads into a tapestry of understanding. That, dear friends, is the art and science of fundamental analysis. Until next time, happy investing.